On to your markets news now. Asian markets had mixed performances while investors were concerned about the impacts of the Russian-Ukraine conflict. Globally, there are concerns about rising oil prices as well as the impact of more severe sanctions on Russia, not to mention that Vladimir Putin has put his nuclear arms forces on high alert. The Japanese market managed to keep its head up at the close, with the Nikkei share average ending the day up 0.2%. Shares in Hong Kong remained under pressure to end the day down, with the Hang Seng index finishing off 0.24% to the red. Meanwhile, over in China, the Shanghai Composite Index ended the day up 0.32%. Over in the United States, markets actually ended on good form last Friday, despite Russia's invasion of Ukraine. The Dow Jones was up 2.5%. The S&P 500 closed 1.5% higher, while the Nasdaq rose by 2.24%. But of course, that could very well change today when U.S. markets open a little bit later. Interestingly, the local all-share index is up today, but it seems to be purely driven by the resources counters alone, with all other sectors seemingly in the doldrums. Let's take a look at the indicators. Well, to break down what's happening for us, I'm joined by Gary Boyson. He's from Rand Swiss. Thanks very much, Gary, for joining us. One would have expected markets to be down quite harshly as President Putin places his forces on high nuclear alert, but the reaction doesn't really seem to be all that bad. What's your reading of things?
If you have a look at it, the European markets are down between between 0.5% and 1.5%, depending on where you look. Germany seems to be doing a little bit better than France, but overall, the South African market is recovering largely because of the nature of our market, the way that our market is constructed. So, as you said in the lead of the segment, the resource index really just helping us. So the overall all-share index up almost 1.7%, but all driven by those resources, and it's the kind of resources you'd expect to be doing well when you have a Russian-Ukrainian crisis. So one, there's a little bit of a flight to safety. So we're seeing a big run up in the gold counters, Anglo Gold up over 6%. At the same time, Russia is a large producer of platinum and palladium. So you're seeing the South African platinum miners really benefiting from the potential disruption in platinum and palladium and those PGM metal supplies. So we've got the likes of Sibanye, which is both a gold miner and a platinum miner, up almost 8%. We've got Anglo American Platinum, it's up well over 7%. So that's helping to lift that resource index. But even the base metals are doing fairly well. You look at something like South 32, also up almost 5%. And I think that's really as the specter of inflation starts to loom. Higher oil prices, disruption to supply chains, and just that inflation picture. If central banks do have to keep interest rates a little bit flatter, feeding into the commodity counters and the commodity markets.
Yeah.
Industrials and financial index down slightly. So all about resources today.
So we're hearing that Russia and Ukraine are going to be in talks at the border, at the Belarus border. Hopefully they can come to some sort of meeting of minds, but that's highly unlikely. And therefore, this situation looks like it's going to be long drawn. So do you think that basically we're going to see much higher prices around things like at the petrol pump and so on and so forth? And how do you think this is going to affect or influence our Reserve Bank when it comes to making decisions around interest rates?
It's a great question, and there's a lot of moving parts and a lot of volatility at the moment. So if you look at South Africa's links to Russia and Ukraine specifically, they're not major trading partners of South Africa. So in a way, the fallout will be limited. But even if the negotiations go well and we do see a resolution to the conflict, in the short term, the types of sanctions that we've seen put in place, the idea that Russia's been removed from the SWIFT system, the interbank messaging system, the heavy sanctions that have been put in place, the potential that, while while Russia might not choose a nuclear option, they might cut natural gas supplies to Germany. All of this feeds into higher oil prices, and South Africa is a net importer of oil. So that will feed into our inflation picture. High inflation expectations, it's going to be very difficult for our central bank. On the one hand, if you look at our central bank does follow global central banks to an extent, and global central banks have a fairly hawkish stance. I mean, we're expecting multiple rate hikes from the Fed, ECB, Bank of England, etc. But the idea that we're going to have high inflation, but also just a severe disruption to the financial system, means that you might see a little bit of a moderation in that rhetoric and slightly more dovish tone coming through, just especially with the major disruption that we're likely to see to the flow of trade.
Yeah, and very quickly, Gary, I don't know how many millions or billions of your clients' monies that you look after, but are you playing it calm in the market? How are you reacting to this very uncertain situation?
So I think it really depends. So looking at us specifically, we're using this as an opportunity to accumulate assets. We don't, we're not overly aggressive. I think there's still a lot of uncertainty at the moment. But generally, what happens is when you get these big shocks to financial systems, and when, especially a story that we're seeing at the moment that just captures the world's imagination, the baby tends to be thrown out of the bathwater. You generally see market prices coming down of companies and of assets that have very, very little to do with the conflict, and that have very, very good long-term prospects. And I suppose the way that we're trying to deploy capital at the moment is to find those companies that are perhaps being unfairly punished and buy into them. We want companies that are going to give us a nice insulation to a high inflation rate, because I think our base case is that we are going to see high inflation rates for the foreseeable future. But with the panic that we've seen in stock markets across the globe, definitely a couple of opportunities out there.
Excellent. Thank you very much, Gary, for your time and insights there. Gary Boyson is a portfolio manager at Rand Swiss.